Welcome to episode 76 of Accessible Finance. Let's dive in.
All right. First, shout out to the new wig from my daughter, Zoe. Yeah. Okay. So, Eric, we had a listener request that said, okay, you guys are frequently talking about these three tax buckets. And it's something I think that can trip up even the most savvy of investors.
Okay.
What are they and why do they matter?
They matter because they impact the amount of taxes that you pay, and they limit your versatility and flexibility in adjusting your taxable income on an annual basis.
Okay. So
Right,
that's
so
a really good bird's eye view.
I did not answer your question though. What are they?
I'm gonna break it down.
Oh, okay.
I'm gonna break it down for us. Okay, so let's start with what are the three buckets and which types of accounts are in each one.
Okay. There's taxable, right, which is what you think of when you say you have an account, probably a bank account, anything like that, right? So checking accounts, savings accounts would fall here. Taxable brokerage accounts. Yeah, that's pretty much it. Those are the taxable. Those are most of the taxable. High yield savings would count, right?
Yeah.
Money market funds, all those things are going to be held in a brokerage account. They could be held, money market funds are security type. They could be held in a variety of accounts.
Sure.
Brokerage account is what we're thinking here.
Okay, so that's your taxable. So that's bucket number one.
Correct.
What's bucket number two?
Tax deferred. So this is, think of your contributions to your 401ks or 403bs, 457b, the workplace retirement accounts that you participate in. Typically, they're going to be tax deferred.
Okay.
Right? Some will have Roth options, which is the third account, tax free, right? So tax free accounts are Roth accounts. So Roth IRA, Roth 401k.
Okay.
That's essentially it.
So we've got our taxable, our tax deferred, and then our tax free.
Correct.
And I think that the majority of people, when you're looking at what you've saved, are focused a lot on the number, but not on the placement of those dollars.
That's a very correct statement.
Thank you.
It's important to know that if we're thinking about, like, if my all-in taxes owed to the government and the federal and state governments are going to be, let's say, 30%. And I have $1 million in my traditional IRA or my 401k at my workplace. Mm-hmm. And then I pull out the $1 million. The amount that I can actually spend would be $700,000 in that case, right?
Yeah.
The $1 million minus the $300,000 of tax, because we said my tax rate was 30%.
Yeah. It's interesting. Just super quick side note. We actually spent an afternoon/evening explaining this to our very inquisitive 11-year-old.
We should do that here. It's an incredible exercise. I think many planners would benefit from that exercise.
It was really beneficial, I think, for him. And he was really excited just to learn about what it is that we do. But it's really hard when you see you finally hit, and for some reason, $1 million feels like this weird benchmark that I think people feel like I've made it when I've cleared this.
Made it to 7 figures.
Yeah.
I'm good to go.
So when you
Set
hit
forever.
$1 million, it's really hard to separate that from what actually is yours and what's pre-earmarked for the government.
Mm-hmm.
So it is really important to be able to break up, what types of funds are where. Okay. So we just went over what those three accounts are, right? And again, to recap, we've got our taxable, tax deferred, and then tax free. So let's start with taxable, which was the first one that you decided to discuss.
Okay.
So taxable accounts can confuse a lot of people. It's treated differently than the other two pretty significantly. So
Sure.
Can you speak a bit to some pros and cons of a taxable account?
Yes. You have the most immediate access to your money with the least strings attached, right? So it's the most accessible to you. It doesn't have to be the most liquid, but typically you'll have some portion of it in highly liquid assets, which is like, checking account, savings account that you can pull from immediately and spend. It will produce tax consequences every year on an annual basis. So the things that happen in these accounts are going to be reported to you on, 1099s, right? And
That's
you're
what
going to have
put in that tax return every year.
Right. And it's going to impact your taxable income and therefore your, tax liability. And so you're going to have to worry about what's happening in there because the IRS does every year and they're going to make you pay for it.
Yeah.
So that's typically how it works, right? You're going to either be paying capital gains or ordinary income tax, interest income. So when you think of like your savings account income or ordinary dividends, which is like money market, interest, things that are typically like interest, right? Bonds, fixed income, that's going to pay you a percentage of the principal or the total that you have in the account. That's going to be taxed as ordinary income. And then when you sell the actual underlying securities, like if you own equities, or if you make a sale of either fixed income or equities, typically that's going to generate capital gains, right? So it's going to be short-term or long-term depending on your holding period. And then dividends from equities are going to be taxed at capital gains rates as long as you've held it 60 days of the 121 period before their dividend. So basically, if you've held it for a while and they're U.S. equities, you're typically going to be, they're going to be qualified dividends, and they're going to have a more favorable tax rate on that. But the long and short is very accessible to you. You can get it really quickly.
Good.
Right? And you have to worry about what's happening there because you're paying tax on it every year.
Annually, yeah.
And then just a real brief aside, I know I went to the 1-2, but I wanted to say that you will hear the term tax drag thrown around by planners because since you occur tax consequences on the earnings in these accounts, right? There's some amount of those earnings that evaporate. They go to the federal government instead of to the account balance to compound.
Correct.
Right. So if you're in a tax deferred or a tax free account and you have earnings, those earnings stay there. They're not removed in any way. Right. And so that you continue to earn interest on the interest. Right. Like you earn interest on those earnings. And when I say interest, I mean returns on those earnings. Right. So if we're talking equities, equities do not produce interest. They produce dividends or capital appreciation.
But your money's working for you. Your money's making money.
There's no limit. I mean, I'm sorry. There's no drag. Right. Or there's no partial payment to the federal government of those earnings.
Right. Whereas in this taxable account, you're doing it annually. Okay. So it sounds like the long and short of it, as you said, is that there's maximum like flexibility and liquidity. But then the downside is that you are getting 1099s and getting taxed.
Right.
On those
We got to pay taxes
annually.
Don't like taxes.
All right. So that was the taxable account. The second account that we talked about is the tax-deferred account. This is one that the majority of people working W-2 jobs are probably quite familiar with.
Right.
So what are some of the pros and cons of the tax-deferred bucket?
Okay. Pros, it will reduce your, typically, not always, there are non-deductible contributions to IRAs and 401ks. We're going to go to the exceptions first, right, rather than the rules?
Always.
Sorry. The pros are it will reduce or typically reduces your taxable income in the year that the contributions are made. Okay, so you're treated as not having realized that income until you pull it out at a much later date, which we'll talk about, right? So reduces your income now, and then it's it's good if you think that your income bracket is higher now than it will be later, right? So that's a benefit. Cons, you have to pay the tax when you take the money out. First, there's a restriction on when you can access the funds. You have to be typically over 59 and a half or 55 and separated from service for a 401k. But there's restrictions as to whether or not you can even get to the funds. And then when you get to the funds and you pull them out of the account, they are always going to be taxed as ordinary income. And some people say, well, wait, it's you don't understand, Eric. I bought VTI or I bought some equities in this account. I bought Apple stock. Okay.
Yeah.
And my Apple stock is appreciated.
Way up.
That's a capital gain. No. That's not. Unfortunately, that's not how the government sees it, and that's not how this works. Yeah. Regardless of what you owned in the account, you're going to be taxed on the balance that you withdrew from the account as ordinary income. Granted, you will have nothing. You will have no tax consequences, incur no tax consequences on the things that happen inside of the account. So while that Apple stock is going up, right? If it's appreciating in value, maybe I bought it for $100,000, and then it's worth $1 million. I go and take out, like, let's assume now that I take out $50,000, I just increase my ordinary income by $50,000, right? And then I pay tax on that at ordinary income rates, not capital gains, even though it was an equity that appreciated. If that were a taxable account, it'd be long-term capital gains. Not the case here. Not, ordinary income.
Yeah. So, that could be a pro for the taxable account right there too.
Yeah.
Okay. So now we've touched on the taxable accounts. We touched on tax deferred, and now we're gonna spend some time in your favorite.
Yes.
The tax free.
It's definitely my favorite.
Yeah.
It's absolutely my favorite. And there's one con that I forgot to mention with the tax deferred accounts, and that is that they have what we call RMDs, or required minimum distributions from the accounts. Right. So if you were born between 1950 and 1959. Then you have to start taking RMDs when you are 73 years of age or older. And then if you're born 1960 or later, it's going to be 75. So for the young people out there, like us, I guess, I don't consider us young.
I wish. I'll consider us young.
I no longer do.
I'm wearing a pink wig, Eric. I feel like
You're young now?
Yes.
Okay, you're
It makes me
reinvigorated?
young.
That's
Yes.
good. Hey, we'll take it.
Yes.
We like that.
Yes.
We feel good
Shout
about
out
that.
Adam's Blue Wig is going to make an appearance next week.
All right.
Yes.
That'll be cool. You'll be Joy from
Oh, I do love her.
Inside Out.
She's my
Good
favorite.
movie.
It is a great
Good
movie.
Highly
actually.
recommended.
I do love
Listeners,
that.
Watch it.
Yes.
But anyway, sorry. RMDs, they're real, and they can put you in tax brackets that you might not otherwise want to be in.
We've seen that happen a lot where if it's not strategically planned out ahead of time, it can very quickly kick you up into some really punishing tax brackets.
Correct.
For sure.
So, as you said,
All right. So, yes, tax-free sounds like a dream.
it
Sounds
is.
ideal.
It's amazing.
Tell us why.
It's the best. Because as we said before, if I have the $1 million in a tax deferred account and then I withdraw it and my tax rate's 30%, I now have $700,000.
Yeah.
If I have $700,000 in a tax free account or a Roth IRA or a Roth 401k, a Roth account, then I withdraw that $700,000. I still have my $700,000.
Right.
Right. I have.
So you're not
as
in a
long
worse
as it's-
position.
Correct. As long as it's a qualified distribution, you're good to go.
Yeah.
Right. Which is typically I'm over 59 and a half. I've had the account open for more than 5 years.
Right.
Then I'm going to incur no penalties and no tax on any of the things.
But someone here might say, okay, if I'm in the same position with $700,000 in my tax deferred or in my Roth, why is the Roth better?
That's a great point.
Thank you.
And it's all about the tax arbitrage. We actually should do a show on the spreadsheet that you did. Okay. Well, it was a nice, colorful graph, large
graph.
paper graph with
It is.
with a time series kind of analysis.
We were trying to visually explain to our very inquisitive children, like we mentioned earlier, about if you were to put in some money to each of these 3 buckets, what the treatment would be if your tax brackets remained the same in all
Right.
3 situations.
And the idea here is if we assume the same rate of return, okay, and the same contributions and the same compounding periods and everything else, then the money that you withdraw would be exactly the same
Yeah.
at distribution. So if the tax brackets stay completely level, right, and your effective tax rate is completely level, including things like IRMA and net investment income tax, then 6 1/2, do whatever you want.
Yeah.
Right? You're going to be exactly the same in terms of how much after-tax dollars you'll have in retirement, whether you're contributing to tax deferred or tax free. However, things are never going to be the same in flat, right? So, and you're going to have to contend with things like IRMAs and RMDs in retirement, and they will impact your ability to manage your taxes. Like it's just you're less flexible when you have RMDs. When the IRS says you have to pay yourself $100,000 because your account's big, right? And then so you're thinking through like what does that look like? You can't give it back. You know what I mean? So,
Correct.
So the idea is what we're doing with the tax-free accounts, and the reason that you'll hear people talk about things like Roth conversions, the reason that these things are meaningful is we're trying to make sure that we're filling up the lower tax brackets throughout, whether that's early on in our career when we're not making a lot of money. We would want to pay tax on all the money we're making because maybe I'm only making $50,000 a year. I just graduated, LSU or something, right? Like I just graduated, I'm making $50K. I expect to make more in the future.
Yeah.
Right. So right now I'm going to pay tax on all my income. And then maybe later if I'm making, $100K, $200K, I'm going to try to defer a bunch of my income.
Right.
So that,
You can pay when you have to realize less
exactly.
income.
Right. So what we're trying to do is fill up the lower tax brackets because it's better to pay lots of tax at 20%.
Sure.
Than some tax at 20% and then later pay a bunch of tax at, 32.
30, yeah, exactly.
So that's the idea is we're playing that game, and that's the differentiator between tax-free and tax deferred.
And I think it really comes down to quality planning and tax knowledge and understanding. We've seen a lot of situations where we've had people who say, oh, now that I'm retired, I should be in a lower tax bracket. And the reality is that they're not, because RMDs, IRMA, and various other things that they are unaware of or cannot avoid
Right.
are hitting them smack dab in the face. And because there was not planning on the forefront, there's minimal things that they can do. Not to say they can't do things,
Right.
but there's less opportunity to be creative there.
Correct. One other thing to mention is that there are no RMDs from Roth accounts, including 401ks. Secure Act 2.0 eliminated the need for or the requirement for required minimum distributions from Roth 401ks. It used to be in there, but it was it was silly because you could just convert it to a Roth IRA, which didn't have the same
Just left
requirement.
the
So
back
the
door.
government's fine if you've already paid the tax on the money.
Yeah.
Which is like to get into a tax-free account, you have to have paid the tax on the money that you're going to put in.
Yeah.
So once you've paid the tax, the government's like, all right, fine, you do what you want with it, right? They're happier for you to take it out because then you don't get all this earnings tax-free.
Correct.
But they'll let you. They acknowledge you've already paid your tax. You're good to go. When it's tax deferred, those earnings they would like to get taxed on, and they want to get taxed on the
wanna make
initial
sure
dollars
it's
that you've
happening.
avoided paying
Yes.
tax on anyway.
They're not going to get away with not getting
No,
paid.
they need to make you take that money out so you'll have to pay the tax.
Now, I can't let you get away with just saying all the pros of the Roth. So
There are no cons.
the con that comes to my mind is just the fact that you don't get your tax deduction when you are putting the funds into the Roth, right?
Correct, right? So if my tax bracket right now is 37%, right? I'm in the highest tax bracket, and I expect that I'm going to retire early. Maybe I'm going to retire at 55
look at you.
or 65 or any time before I'm going to elect Social Security.
Yeah,
and my
and get
RMDs are going to kick
RMDs,
in, right? Because
sure.
mine aren't going to kick in until 75. We talked about. I'm born before 1960. I mean, after 1960. Sorry.
I was going to say, my gosh, you're really aging yourself.
Ooh, that could have been rough.
You need the pink wig.
Yeah. So if I'm in a high tax bracket now, I expect that I'll be in either a lower tax bracket later. Well, I'll be in a lower tax bracket later for a number of reasons. If I'm retiring early in this case, I'll be in a low tax bracket theoretically, unless I have just loads of money in my taxable accounts. But point is, I might want to defer my income now, so pay as few taxes as I can, or as few dollars in taxes as I can in the 37% bracket, and then later I can fill up the 22, 24, 32 with Roth conversions and get the money into a tax-free account at that point.
Correct. Okay, love it. All right, so we've gone through what the three buckets are. We've gone through some pros and cons. And so then at this point, you might be wondering, like, okay, which one's the best bucket for me to put money in? And the answer is all three. So why, Eric, is it important to have money in all three of these buckets?
I guess I'll answer your question, but if we could wave a wand and not pay any taxes, we would put all of our money in a Roth account.
Well,
We'd be
okay,
thrilled.
sure. But like if somebody comes to us, right? If a client comes to us and says, every dollar I own is in Roth. I have no checking,
You're
no
right.
savings. I have no 401k. I have no tax deferred.
Right.
That really limits your
Honestly,
planning opportunities.
Yes, that's happened, right? Like you don't want to, just to be clear, we are not advocating extreme 1-year Roth conversions where you take all of your tax deferred dollars and you put it all in a Roth account, convert it all to a Roth account. That's typically wrong.
I will say,
That is-
caveat real quick before you get into your thing. I think the reason that
Get into my thing.
Yeah. I think part of the reason that you're so pro Roth, though, is that there has been so much confusion around Roths and what they are, to the point where people have avoided participating in them. Especially, like, I know our parents' generation was kind of like, that's for like young people. And so it's an amazing tool that's been underutilized because people just simply didn't know enough.
There's aversion to things that are new, right? So, people didn't want to use it right when it came out.
Yeah.
But it allows for flexibility in tax planning. Obviously, the money's great when you get it there. But you would ask the question, why would you want all three?
Correct.
Okay, so really part of the planning that you would do, tax planning, is as you're approaching retirement, you want to have enough money in your taxable accounts and enough money in your tax deferred accounts to be able to fill those lower tax brackets as we're in those artificially low years.
Yeah.
Because if I pay all my taxes at 37%, right, my whole life,
Yeah.
I'm a high earner, and congratulations to me. Maybe I'm a doctor or a lawyer, great. High earner, paying all these taxes, okay? And now I retire at age 50 or 55, let's say, okay? My tax bracket might be very low.
Yeah.
I might be in the 12, 22% bracket. And so now I
'Cause
paid
you're not
so many
making the
taxes at
income.
37%. I lost the difference between the 37%
Yeah.
and the 22%.
Yeah.
I've lost that
Like
15% delta in taxes. I handed
On a
an
lot of
extra,
dollars.
Exactly. I
On a
handed
lot
an
of
extra
dollars.
15% to the government. What I would rather do, what I ought to do, is have enough in the tax deferred so that I can convert that over time to fill the lower brackets. I can either withdraw. You don't have to do a Roth conversion. You might want to spend the money. So I could
Get a boat.
get a boat or two. I think
Or
it'd be
two.
really sad that you did. But no, you absolutely can. The idea is you want to fill those lower brackets, whether it's with distributions or withdrawals from the accounts or Roth conversions. You want to have that able to be done, right? Like, so you want to be able to convert the money, but when you convert the money, you're still not touching it, right? It's going into a Roth. So I need the taxable account to be able to substantiate A, my spending if I'm retiring early, and B, the taxes on the Roth conversions.
Yeah.
Because it does, remember, we have to pay the government, even if it's a 22%, which we're happy to do because it's not 37%.
Correct.
It's still 22% of whatever, we're putting into the bracket that we have to pay.
Exactly. So it sounds like in order to be able to have a strategic withdrawal strategy, you need to be able to have funds in all three accounts.
Correct.
So that depending upon what your actual situation looks like annually, you can make decisions, accordingly.
Correct. It gives you the most flexibility.
Correct.
Right. So, I mean, if you only could pick one, you'd put most in your Roth. You'd have some in your taxable. But obviously, you don't want you just want to avoid the years where you're going to have almost no way to fill the 12 and 22% brackets. Right. Those are low brackets. You should pretty much always be willing to pay taxes.
And it's
in the
interesting.
10 and 12, if you don't fill the 10 and
Yeah.
12, you're probably doing something wrong.
And
or
it
did at some point in your
sounds
life.
really antithetical to say, like, you're looking to pay taxes in the 10, you're looking to pay taxes in the 12. And the reality
Right.
is that the government's going to force you to pay tax on every
Exactly.
single dollar anyway.
Yep.
So if you get to control where you're paying it rather than them, you're going to end up paying a lot less in taxes.
Exactly. Chances are, if you're not paying taxes now, you either paid too much in the past or you're going to pay too much in the future.
Yes.
That's the way I would think about it.
Correct. I mean, we've had, clients come to us that were really proud that there were years that they were in the 0% tax bracket. And that's such a missed opportunity because,
Sometimes not even using the standard deduction.
yes.
Yep.
So the reality is that we all know the government's going to get their piece. So as much as you get to control the narrative there, you're far better off. And so having those three buckets is really the way to do it.
All right.
All right. Anything else that you want to say to viewers or clear up or clarify?
I think we're good.
All right.
I'm excited.
If you have any other questions about the three buckets, or if you have a breakdown you want us to weigh in on, like I have X% in Roth, X% in taxable, let us know. Shoot us any questions that you have at podcast@equilibriumfp.com.
All right. Thanks, guys.
Till next time.